Luckily, we are no longer in the dark ages where you needed a degree in computer science in order to buy or understand how to invest in cryptocurrency. Nowadays, the process is pretty simple and you have different avenues of actually investing in cryptocurrency, whether that's buying it off an exchange, getting exposure via stocks or ETFs, and in this video, we'll be covering all of those items. The easiest way to get exposure to Bitcoin or any cryptocurrency that you're interested in is to sign up for an exchange, specifically a centralized exchange like Coinbase, Gemini, Kraken, you name it. You sign up for one of these and you can directly buy cryptocurrency with a credit card, or you just connect your bank account. Now, OGs have trust issues when it comes to exchanges because back in the day, exchanges weren't necessarily secure. There's a lot of hacks on the actual exchange and people lost a lot of money back in 2014 with Mt. Gox, even up until today, with headlines like Bitmart getting hacked for 196 million, Japanese exchange Liquid getting 90 million taken. That tends to happen on these smaller exchanges. With bigger exchanges, they tend to have more of a focus on security. Companies like Coinbase have thought about this as they're building out their products. Things like 98% of their funds being stored offline, them having two-step verification for all accounts, everything is encrypted. These companies also tend to hold insurance policies in order to cover any cybersecurity breaches. Of course, if you're handing out your login information and your cryptocurrency gets stolen, that may not be covered. Basically, you try not to be an idiot and fall for any phishing sites or email scams. You have to be extra protective of these crypto accounts, because if cryptocurrency is accessed and sent out of your wallets and it is your fault, those transactions are final and nothing is covered by the FDIC or backed up by the government. Also, it's a little comforting when a company like Coinbase is a publicly traded stock at this point. It's located in the US. It's held to a higher standard than offshore exchanges. Something like this company is much better than the exchanges that I was talking about. The reason I even bring up the security of these exchanges is because a lot of people end up leaving their cryptocurrency on the exchange after buying it. You can disregard any of these concerns if you buy the cryptocurrency and then move it to a software or hardware wallet where you're in full control of your private keys and your cryptocurrency. Now, this video isn't sponsored by Coinbase, but I do use it as a platform, or one of the platforms, for buying cryptocurrency. You simply look up any asset that's on the platform, let's say Ethereum, you go to buy, you put in the amount, whether that's in US dollars or the cryptocurrency itself, and you set up a bank account or a credit card. You can see if I want to buy $200 worth of Ethereum right now, there's a Coinbase fee, which is a little high when you think about it as a percentage, but that is the price you pay for convenience. If you want to lower those fees, there's actually a hidden trick, because if you use something like Coinbase Pro, which is an exchange that's owned by Coinbase, when you create a Coinbase account, you instantly have a Coinbase Pro account. You log into that, and the fees for the same amount of Ethereum being purchased is lower. Instead of depositing money onto your Coinbase account, you would just put it here in your Coinbase Pro account. You see, if you're buying $200 worth of Ethereum, the fee is $1 instead of $3 on Coinbase. Also good to mention that any movement between Coinbase and Coinbase Pro doesn't have any transaction fees, so you don't have to worry about that. That's centralized exchanges for you, really easy to use. The one watch out is the fees. Also, there are some that offer free trading or no commissions, but there's actually a spread, and the price that you're paying for those assets is actually elevated in order to compensate the exchange. Another option that's increasing in popularity amongst traditional brokerage accounts is they are offering the ability to buy and sell cryptocurrency. You just don't own the cryptocurrency, so you can't spend it, you can't transact in cryptocurrency, but you do have exposure to the price swings. The other type of exchange that exists out there is actually running on cryptocurrency itself. It's known as DeFi, decentralized finance, and so you have exchanges like PancakeSwap, Uniswap, running on different blockchains that you can actually go on if you already own cryptocurrency and exchange it for other cryptocurrencies through these swaps. Now, I'm not going to go too much into detail here, because if you are a beginner, it's much easier to get started with a centralized exchange, and as you learn more about cryptocurrency, then you can start to dive into how DeFi works and dip your toes into DeFi exchanges. The purest form of exposure to cryptocurrency is owning the underlying asset and buying it off an exchange, holding it into your wallets, and waiting for the price to increase. If you don't want direct exposure, there's other ways to get indirect exposure. The first being crypto stocks. In which case, we already talked about one in Coinbase, which mostly gets their money from their exchange. Buying stocks like Coinbase, you're benefiting from those higher transaction fees because that's how the majority of the money by Coinbase is made, via transactional revenue. Now, they are growing other areas of their business, like the learn and earn, you have staking, they're working on other stuff. You can kind of be the one selling shovels in the gold rush. Whether the price of Bitcoin goes up or down, Coinbase is making money from the exchange volume. Or you have stocks that are involved with crypto mining, like Marathon Digital Holdings, ticker symbol MARA, or Riot Blockchain. You can think of crypto miners kind of like a gold miner in relation to gold. The price of Bitcoin does matter a bit for Bitcoin mining, but so as long as these companies are producing Bitcoin at a lower cost than the price of Bitcoin, they are making a margin for that difference between the cost and the price of Bitcoin. That's how they make money. Then you have semiconductor stocks like Nvidia that actually make money when the cryptocurrency space is doing well because their hardware and chips are used in a lot of cryptocurrency ventures. Even if you invest in stocks like Square or PayPal that are known for the traditional payment side of things or digital payments, they are also getting involved with cryptocurrency and trying to figure out ways to actually get involved with the blockchain. I mean, Square officially is changing their name to Block to emphasize their focus on the blockchain. Jack Dorsey clearly taking a play out of the playbook from Mark Zuckerberg. Then you have the world of ETFs or exchange traded funds. Something like ProShares Bitcoin ETF is actually not based on the spot price of Bitcoin, but it does use futures to get exposure to the price movement in Bitcoin. Personally, I would never touch that futures ETF as it's a little bit misleading when it comes to management fees as well as contango, dealing with futures, rolling them out further in time, and it doesn't necessarily correlate 100% with the move in Bitcoin. Then you have the Grayscale Bitcoin Trust, which isn't technically an ETF, but it's in the realm. They own Bitcoin in the trust itself, but the problem with this one is the underlying assets that are owned by the trust don't necessarily equate with the price or value of the trust itself. So sometimes there's a premium or a discount. It just doesn't necessarily trade one-to-one with the price of Bitcoin movement. Then you have Michael Saylor and MicroStrategy, which does have a business, but 99% of what they do seems to be taking out loans or raising capital to buy more Bitcoin. So in a way, this is also a proxy ETF, while a spot ETF waits to get approved by someone like the SEC. Then you have ETFs that are focused on cryptocurrency stocks and not necessarily an underlying asset like Bitcoin or Ethereum. So within Block, BLOK, there are different crypto companies that you get exposure to. That way you're diversifying your risk across a bunch of different crypto companies instead of just one. Over time, I expect the number of stock ETFs that are related to different parts of the crypto space will pop up because recently there was a crypto ETF that got approved that is purely focused on NFTs and NFT technology. If you want the most exposure to price swings in cryptocurrency, owning the underlying asset is definitely the move. When it comes to volatility though, prepare for major drawdowns. As the history of Bitcoin has shown, there can be drawdowns of up to 90%. If you're not a big risk taker, it's just a watch out. If you want less exposure to the price swings in cryptocurrency, then buying businesses that are in the ecosystem itself is a little bit less volatile, and you have businesses that are making money, whether cryptocurrency is going up, down, or sideways. If you guys did enjoy this video, make sure to hit that like button, as well as consider subscribing to Major Rule, where we talk cryptocurrency, stocks, anything to do with money. Thanks guys for watching, and have a great day.